Hello, I'm Grace. Major Korean commercial banks have moved swiftly to curb a surge in debt-driven stock trading, sending warning signals across the market. KB Kookmin Bank and Hana Bank drastically reduced their new credit loan limits, signaling a coordinated effort to cool down speculative borrowing. Both institutions capped maximum new credit loans at 100 million Korean won, a move widely interpreted as a stringent regulatory measure to suppress stock investments fueled by excessive borrowing. Concurrently, limits on minus checking accounts were also tightened. With these primary channels for securing additional funds now blocked, investors face immediate liquidity concerns. These actions came just one day after financial regulators warned of the dangers of debt-fueled investing. The banks' rapid adoption of regulatory intent demonstrates their role in acting as a brake for market stability. The 5 largest commercial banks effectively locked credit loans almost simultaneously. This appears less as individual bank initiatives and more as a unified crisis management strategy across the financial sector. The reduction in new loan limits has significantly diminished the capacity of individual investors to raise funds. The 100 million won cap, in particular, dealt a direct blow to those relying on high-value loans. Tightening minus checking account limits raised psychological barriers beyond mere numerical adjustments. Investors now face situations where they must abandon plans to withdraw cash or seek alternative solutions. These measures are closely tied to recent volatility in the KOSPI index. Market anxiety has intensified as forced liquidations, due to debt-driven trading, reached their highest levels in 2 years and 8 months. In response to investors hastily withdrawing cash through forced liquidations, the financial sector proactively blocked risks. This is a precautionary step to prevent systemic risks that could arise from over-leveraging during a bull market. The financial sector is expected to maintain a conservative stance. Following regulatory warnings, loan assessments are likely to become stricter, and credit evaluation standards are expected to tighten. These changes will indirectly affect ordinary households seeking living expenses. As credit loan channels narrow, attention is shifting toward alternative financial products for securing daily funds. Funds are likely to move toward deposit interest and other financial instruments. While this implies a short-term liquidity drain from the stock market, it could contribute to restoring a healthy financial ecosystem in the long run. Reports suggest these measures are viewed not merely as tighter regulations, but as essential steps for market stability. Reducing debt risks from overlending is currently the top priority for the financial sector. Investors must recognize that borrowing for stock trading is no longer easy. Indiscriminate debt-fueled investing can lead not only to personal bankruptcy, but also to instability across the entire financial system. The financial market is expected to enter a stabilization phase. However, careful asset management will be required until the use of excessive leverage is fully curtailed. For a healthy financial life, budgeting aligned with one's income level is essential. This is a moment where long-term financial stability takes precedence over the pursuit of short-term gains. Actions by financial regulators and banks will help quell market overheating. Yet, improving the culture of debt-driven trading requires a parallel shift in investor mindset. Anticipating stricter lending conditions, investors should adopt a habit of comparing and reviewing various financial products. In a complex financial environment, sustainable asset growth will be the key challenge. I'm Grace, thanks for watching.